Hi, everybody. My name's Colin Murphy, and welcome to Torcana Podcast number 8. Today, I'm going to talk about the 10 most expensive mistakes people make and how to avoid them. It's got some similarities to podcast number 5, which also talked about mistakes people make, but this one's going to be a little bit more elaborate and a little bit more detailed, okay? So it's funny, real estate is not that complicated. It is a tried and trusted way of building wealth for generations and generations. And I mean, if you get your timing right, and I believe firmly that this is a great time to buy real estate, if you can get your timing right, it's not that difficult to get it right. The reason people get it wrong is they make the same silly mistakes again and again, and I'm going to point out what those mistakes are, how you can avoid them, and by doing so, how you can make real estate a relatively straightforward way of building a passive income stream and building wealth. Okay? So the first big mistake, and these are in no particular order of importance, by the way, the first big mistake I see people making or trying to make, I've talked people out of it sometimes, is when they try to choose the highest rental return or the highest advertised rental return instead of the best property for them. I mean, every day I get emails from sellers promising outlandishly high returns, 10%, 15%, 20%. And it's just so high. I mean, you have to bear in mind that the higher the advertised return of a property, the higher the risk. And that goes with any financial product or any investment anywhere. I mean, if you're not adding any value to a property and somebody's promising you a double-digit return, it's simply more risky than something that has a lower return. That's all there is to it. I mean, you can obviously double check the price, but the chances of you getting an unbelievably good deal at a great price without you actually doing anything are just slim. Chances are you're missing something. Okay, so higher the advertised yield of a property, the more interested people are going to be in buying it. If you see two computers in a retail store and one is saying this one's $200 and the other one's saying $400 and they both look the same, you're tempted to buy the $200 one. There's often a very good reason why one is double the price of the other one, and property is no different. It's just, for property though, it's proportional to risk. I mean, you can earn 10% buying Greek government bonds or 1% buying US government bonds, or even a negative interest rate buying Swiss or German government bonds. There's a reason for it, and real estate's no exception. The highest yielding properties are never the safest ones, they're always the riskiest ones. And to put it in plain English, in my experience, the properties with the highest potential returns where you've added no value will almost always have higher maintenance fees, higher management fees, more transient tenants, higher local unemployment rates, poorer access to schools and employers and amenities, and basically difficult prospects for resale. So if everything goes perfectly well and you don't have any vacancies and by some miracle nothing breaks, you'll get your 15% return. But years 2, 3, and 4, you can expect half of that. I mean, even on a cheap property, a single that you earn $7,000 or $8,000 a year, a broken air conditioner will cost you $3,000. A 3-month vacancy can cost you $3,000, and there's half your return gone. And obviously, it can get worse than that if you have damages to floors or roofs or any kind of big ticket items. It can make a very big difference. So just bear that in mind. I think there's a happy medium. If you're looking to purchase out of state or even overseas, you don't want to expose yourself to too much risk. You want something that's relatively safe, stable, predictable, secure, and that's going to mean realistically single-digit net returns. I mean, I'm lucky enough to be able to secure, single-family homes in certain suburbs of Tampa, Florida, which can generate realistic net returns of 8%, 8.5%, 9% tops. And even those change every year. Sometimes you have expenses and sometimes you don't. But just don't believe the headlines on your emails. You need to look into it and bear in mind what kind of risk you're prepared to take and what kind of hassle you're prepared to accept for those kinds of properties. Okay. Second mistake I see people make is rushing into a purchase that doesn't suit your budget. I mean, you might think people don't rush into buying property anymore, that we've all learned our lessons from the crazy boom periods in 2003, 4, 5, 6. But it's just not the case. Peer pressure is still there. People still dream of owning a home they can't afford. Buyers still worry that they might miss out if they don't take action right now. People still seek reassurance from the seller, of all people, that it's a good idea for them to buy that kind of property. So budget's a very important issue, and I'm not really just talking about setting aside funds for expenses like repairs and maintenance and vacancy periods. That's important. I'm more talking about making sure you can afford to buy the property in the first place. I mean, you need to have your rainy day money first. I think people should always have at least 6 months worth of income in the bank account as enough money to survive for 6 months without any money before you invest in a property. So in other words, if you need $5,000 a month to pay your bills and feed your family, you need to have $30,000 saved in your bank account that you don't touch. That's your rainy day money. If you need it for something, you build it back up again to 30,000. So, and whatever's above that, that's the money you can invest, either buying it with cash or putting down deposits or whatever you want. But always have that 30,000 rainy day money set aside first. That's the prudent thing to do, and don't invest too much of your cash in real estate either. I mean, you should have a diverse portfolio of investments, and you should seek professional advice on all of those. Your timing is also important. Don't, if you have a full-time job and kids and a busy lifestyle, don't think that you can buy a property today in January and sell it in December and make lots of money. That's a job. I mean, that's what I do, 50, 60 hours a week. That's not something you can really do easily part-time. I mean, I think investing in real estate, for people that don't do it full-time, it should be a medium to long-term endeavor. You should be investing in it for 3, 5, 10, 15, 20 year periods. That suits people that have busy lives. I mean, and that's by far the easiest way to make money. I know the most, any money I make in real estate, any real money, is going to be made on the properties I buy and hold. It's not going to be made really on the properties I sell. The properties I sell to people is really just to fund the long-term purchases. That's where the real wealth is. That's where the real passive income is. So I think real estate, you should think about it long term, and too many people make the mistake of thinking about it solely on short-term metrics, and I think that's a mistake. Number 3 on my list of 10 is people that mix investment and vacation properties. I mean, for me, really, they're like oil and water. They couldn't be more different. An investment property is simply an asset you bought to maximize your rental income and your potential capital growth. If you're lucky, you'll have the same tenant for several years and your monthly income will be quite regular. These properties are not for personal use. They don't have to be in neighborhoods as nice as the neighborhoods where you live in. They don't have to be near schools as nice as the schools you send your kids to. They just have to be sufficiently good to provide you a stable and secure source of income. That's an investment property. A vacation property is obviously a vacation property, a holiday home, one you buy and you use yourself, or you let your friends and family use it. Obviously, income can be earned from a vacation property. Lots of people, millions of people, earn money from vacation properties, but it certainly shouldn't be considered a regular or a reliable income stream, because it's just not. Some months you can earn lots of money, other months you earn nothing at all. You still incur the running costs. And also, I mean, tourists can be fickle. Management expenses for short-term rents are very high. They can be as high as 30 or 40% of your gross income. And, to be honest, they work for it. It's one thing to have a property manager dealing with the odd phone call from a tenant that has a 1-year lease. It's quite another for people that are getting 6 families in and out of a property in the busy July, August season. That's a hell of a lot of work involved in doing that, and you've all the cleaning and towel and blanket changes that go with it. So that, they earn that money, and but it's expensive. It really eats into your income. So, and more importantly than that, the exit strategy for an investment property often involves finding a local buyer who wants to live full time in that area. I always try and buy in neighborhoods that are populated by lots of owner occupiers. I don't want to buy somewhere where it's just all renters. So if you buy in a nice location, you should have no trouble selling it at a future date at whatever the market rate is, probably to somebody who's getting a mortgage. On the other hand, the exit strategy for a vacation property Usually involves finding another out-of-state or overseas person who'll buy it as a holiday home. So that's a shorter list of potential buyers. Even if you're buying somewhere in Orlando with millions of tourists and millions of buyers, it's still a shorter list of potential buyers. So, in my view, there's a profitable and very easy way and smart way to mix vacation homes with investment homes. The expensive way is to rent out your holiday home when you're not using it, okay? And that probably means you don't use it during peak periods because you don't want to give up that income. The simpler way, the more flexible way, and the more profitable way is you buy your investment property, you rent it out long term, local person. You don't do anything with it. You don't use it, and you use the money that you earn from that property to go on vacation. You can rent a big pool home in a different place every year from the money you earn from your nice little 3-bed single family home. That's the smart thing to do. I mean, the income earned from a 3-bed single family home might be $7,000 or $8,000 a year. That's plenty of money to pay for some flights and a big pool home wherever you want. You shouldn't really mix the two. You're just inviting a lot of hassle for yourself. Fourth thing on my list is underestimating the importance of inspection reports and repairs. And having a professional inspection carried out after you've signed a contract and made a deposit, but before your inspection period ends, is the best way to identify any major potential repairs. I mean, a competent property manager will identify issues that a layman, and I include myself in that, wouldn't notice, that could be relating to the wiring, the plumbing, the insulation, any infestations, the heating and air conditioning units, any damp, any life expectancy of the roof. I mean, these reports cost, depends on how much detail you want to go into, but $80 to $250 is usually what they cost, and they could, and they have saved people fortunes. I mean, it could be something simple where recently I bought a property and the owner told me the air conditioner was in great condition, but the property inspector said it had about a year left at most, that it was about to kick the bucket. So I negotiated a discount on the contract on that basis. Other times a roof might look perfectly fine, but it might be a 20-year roof that's 19 years old. So that's going to cost you $6,000 or $7,000 to replace it. You want to know that kind of thing before you jump in and buy it. So they're the kind of major expenses you want to identify in advance. Repairs, always very important. I think you should always set aside, 5 or 8% of your gross income should be enough for repairs. But I think just to be safe, you should always have, maybe 2 or 3 months worth of rent in that account to pay for any repairs that might come up, and you just leave it at that 3 months. Once it builds up to that 3 months, you leave it in there, and then you take all the rest of the income out. That's the easy way to do it. That's the way we do it, rather than put a certain percentage in every month. I just let it build up to 2 or 3 months worth, and then I take out everything else on top of that. Okay, so number 5, and I touched on this briefly, is not knowing the risks that come with very cheap properties. I mean, it's funny how things change. I mean, during the boom, buyers looking at investment property, certainly in places like Florida, usually bought the most expensive house they could afford. I mean, they might have really been people that should have bought a modest 3-bed home, but they were like, no, let's get a 5-bed pool home with a back garden because somebody's going to lend us the money for it. So, but in the subsequent crisis years, people did the exact opposite. I mean, they bought the cheapest property they could get their hands on, using just the price as a substitute for research, as in, it's $50,000 and it used to cost $120,000. What's the worst that can happen? Somebody's going to rent it. I mean, that's, property values may have fallen a lot, but that doesn't mean the cheapest properties make the best investments. I mean, they're often the most loss-making and the most time-consuming. And, I remember very clearly lots of times where something looks great on paper, might be maybe a condo community where it's only $60,000. It looks like it's got a pool. It's near Disneyland. It's 10 minutes from this, that, and the other. And, people are promising high yields, but if you dig into it, you might find that the home ownership association have no reserves, totally inadequate to maintain those facilities and the building structures. There might be lots of foreclosures or short sales in the community. Average household income would have been one of the lowest in the city. Crime rate was very high. Many of the leases in those units were about to expire. I mean, the neighborhood surrounding it was very gritty. It's probably a nice way of describing it. So, you just need to be careful. I mean, those kinds of areas will have rent decreases because there's too many vacancies. The HOA fees are going to increase because not enough people are going to be paying their monthly dues. Your repair bills are going to be high because these are older properties, and tenants, in these kinds of rundown areas are basically more likely to break stuff than those renting in nice, well-maintained neighborhoods. That's just a fact. You're going to have more vacancy periods. So these kinds of cheap properties that I just described can be awful. I mean, they can include an unbelievable amount of stress. I mean, so if you're not careful buying a cheap property, buying cheap properties during the downturn and early recovery can cause just as many problems as the people that bought expensive ones back in 2005 and 6. So I'd really be very careful there. Number 6 on my list is not doing your homework on the selling agent. In my experience, buyers spend the vast majority of their research time looking at potential properties, but not enough doing their homework on the person or company who's actually selling it or promoting it. I mean, just doesn't take a lot of time. If you ask them the right questions, doing your homework on those people are very easy and worthwhile. If your agent or realtor's been in business for a few years, they should be happy to put you in touch with a couple of satisfied clients who can verify they're happy with the service received. I mean, I'm not talking about directing you to a link on a website with some, kind of written platitudes from people. I'm talking about actually making the effort to email and speak with previous buyers. Every realtor has a license number you can check. Even if you're dealing with an overseas-based agency, they should be able to supply you with banking and accounting references. So don't be afraid to ask for that kind of stuff. I mean, from my point of view, I like it when people ask for that. For me, that's a buying signal. It shows that somebody's serious. I'm very happy to give them whatever they need and put them at ease and put them in touch with buyers from their area. So, for example, if an Irish person is getting in touch with me, I'm happy to put them in touch with other Irish people that have bought recently. If it's a Canadian, I'll put them in touch with a couple of Canadians that have, done business with us before. That's no problem at all. So there's no reason why you shouldn't be doing that. And also be wary of kind of jacks of all trades, where you have some overseas agents who promote properties in a wide variety of countries or a wide variety of cities. I mean, the majority are honest and well-meaning and legitimate, but their lack of local knowledge will hurt your chances of securing a profitable long-term investment. I mean, the likelihood of an overseas agent with a limited knowledge securing a genuinely great property in today's competitive markets, I think is pretty slim. The market's just too competitive. So, try and deal with people that are on the ground and are happy to supply basic references, and then focus your energies on the property, okay? Number 7 on my list is failing to appoint a competent property manager. I think I've touched on this in a couple of podcasts. It's obviously very, very important. Property managers basically have 2 roles to play. First one is to keep you, the property owner, happy. Second one is to keep the tenants happy. It's not an easy job, pretty thankless, pretty labor intensive. I certainly wouldn't want to do it. That's why we always employ licensed property managers to look after our properties, and I'd certainly recommend you do the same. I mean, a good licensed property manager is worth his weight in gold if they take care of your properties over a number of years. I mean, look at their fees. Bear in mind they charge additional fees for placing tenants, renewing leases. Make yourself aware of those, put them into your long-term calculations. And, the better a manager is at doing his job, the happier the tenant will be, the longer they'll stay. Because, having tenants move in and out on a regular basis is a lot of hassle, it's stressful, it's expensive, it's a real pain. So, bear in mind what they do. These managers they liaise with your tenants, they ensure they get paid on time, they organise any repairs necessary. They should be communicating with you on a regular basis, paying you your rent, sending you your monthly statements, placing new tenants when there's vacancies. So just bear that in mind. Some people think, some people that have had a bunch of vacancies in a row, where they've owned a property for 3 or 4 years and are on their 3rd or 4th tenant, you might think, okay, there's something wrong with the property. It's not a very good property. And often it's just something wrong with the tenant screening. They're not looking for the right kinds of tenants, or they're not managing the tenants properly. So that is often the case. I mean, obviously the home needs to be, clean and appealing, but there shouldn't be any excuse for not having stable tenants. It just means you need to spend a bit of extra time finding a good manager that can minimize those vacancies and down periods for you. Okay. Number 8 on my list is, a mistake I see people make, and this can be a horrendously expensive mistake, is forgetting to file tax returns. I mean, anybody who owns a US property, doesn't matter where you're based, whether you're based in the US, Canada, Panama, wherever, anybody who owns a US property must file tax returns to the US authorities every year, even if your property is not earning any income, even if it's vacant. Any overseas owners need to get a tax number. It's called an ITIN number, and a non-resident social security number. They're both very easy to apply for. The 1040N is the standard form most people need to complete for their tax returns every year. It's a pretty simple process. Filing, you can do them yourself. I wouldn't recommend it. It is a little bit tedious, but you can get an accountant to do it for you for a couple of $100 in fees. Because failing to file tax returns and paying property tax is a serious issue in the USA. If you don't do it for long enough, you'll lose your property. They'll literally take it off you and foreclose it and sell it to somebody else in an auction. And you might have paid $100,000 for your property. If you accumulate enough unpaid taxes, it might only be $5,000 or $10,000 in unpaid taxes, they'll foreclose that and sell it to some other guy for $50,000 and take their tax owed from it. So that'll happen. I've seen that happen. So make contact, appoint an accountant during your first year of ownership. Be familiar with where, search for your county. If you bought a property in Pinellas County or Hernando County or Polk County or wherever, just search for, Pinellas County tax appraiser. You can see what taxes are owed. You can often just pay them online. It's as easy as buying anything online. You stick in your credit card number. You can put in your email address to get alerts. So don't fall into that trap, okay? Number 9 on my list is forgetting that capital appreciation takes time and patience and planning. So, obviously back in the heady days, too many people invested, in short-term timescales. They just bought now because everybody was buying and they wanted to buy quickly before prices went up even further. They didn't think about the taxes, the finances, the cash flow, the underlying demand, any of that stuff. So, don't fall into that trap. I mean, anybody fortunate enough to be acquainted with financially successful people will agree that these people are generally organized and are unlikely to invest their hard-earned money without having a plan in place. I mean, if they want to retire in 15 years time, they probably have a 15-year plan in place, or certainly multiple 5-year plans, or certainly goals basically, and they have a firm control of their cash flow. They stick to a basic set of rules before they commit to anything. I don't know all those rules. I won't pretend to know them, but I mean, certainly short-term investing is for gamblers. Very few people can do it successfully. It's okay to do it if you're doing it full time. I guess even that's not easy though. Purchasing something, as I said earlier, with a long-term view is way more likelier to yield profits, proper profits. So bear that in mind. High quality assets, another rule, high quality assets attract a premium. I mean, if you want something to be stable and generate a long-term income with a minimum of headaches, be prepared to pay a little bit extra for a better location, a little bit extra for a bigger property, for better facilities, pay a bit extra to a great property manager compared to a regular property manager. I mean, these additional costs will almost always pay for themselves many times over in the long run. The rule is stay away from gimmicks. The best deals don't have them. I mean, be careful of guaranteed, inverted commas, rentals. Don't kind of buy on the basis that there's a great golf course nearby, or there's a new airport on the way, or they're building an extension to that road, or there's a big global event like the Olympics or a World Cup or whatever coming to town. Just stick with the basics. Where do people want to live? Is this a good neighborhood? Is there got nice schools and employers nearby? Is there easy access in and out? I mean, is it a nice garden? Is it well protected from floods and whatever else? Just stick with the basics. That won't change. That'll always be important to people. Okay, so getting towards the end, number 10 on my list is not spending enough time thinking about an exit strategy. I mean, obviously some people, their buying time frame is forever. They buy when they're 40 and they just don't ever intend to sell it. They intend to keep it forever, pass it on to their kids. That's great. Either way, I mean, I've always believed in some simple universal principles for property investing, and they apply equally to booms and equally to busts, and they are that you buy in the best location your money will get you, that you avoid buying at the top of a cycle, that you don't try and look for the exact bottom of a cycle, you just buy when things are recovering or on the way up. We're clearly in that part of the cycle at the moment. We've clearly had a huge bust. Prices fell dramatically, and prices have been recovering for 4 or 5 years now. So you're clearly at the start of a new kind of 20 to 25 year cycle. Next is crunch your numbers carefully. Know what numbers you need to crunch and do it carefully. Understand what due diligence is necessary and do it. So over the long term, if you can adhere to those pretty straightforward principles, there's a bit of education involved at the beginning, but if you can adhere to them afterwards, real estate will be a strong wealth preserver for you. It will be a steady income earner and a smart hedge against any inflation we're going to see in the future. So, just think carefully about, where you want to be in 8-10 years time. Work backwards from there. Bear in mind that it's generally a lot safer to purchase in areas where locals buy and rent and locals buy, that they're not as prone to bubbles as other areas. So I believe that it's, if you want to be in a certain place in 8 or 10 years time, it's now the decisions you take now will decide that, not the decisions you take in 7 or 8 years time. So if you're willing to choose carefully, investment property in places like Florida and places like Tampa where we're active can be a tremendously rewarding and profitable addition or start to a balanced portfolio. Okay. So let me just recap very quickly on these 10 most expensive mistakes people make. First one is choosing the best rental return instead of the best property. Number 2 is rushing into a purchase that doesn't suit your budget or timings. Number 3 is mixing investment and vacation properties. Number 4, underestimating the importance of inspection reports and repair budgets. Number 5 is not knowing the risks that come with very cheap properties. Number 6 is not doing your homework on the selling agents. Number 7 is failing to appoint a competent property manager. Number 8, forgetting to file your tax returns. Number 9, forgetting that capital appreciation takes time, patience, and planning. And number 10, not spending enough time thinking about your goals and thinking about an exit strategy. Okay, so that's it from me. I'm Colin Murphy from Torcana. Thank you very much for listening. There's lots of other information available on our website, www.torcana.com. That's TORCANA.com. We also publish a blog on info.torcana.com. You'll find my contact details there. Very happy if people want to reach out to us, ask some questions, partner with us on some deals. Always interested in talking to people about real estate, so feel free to reach out. This is Colin Murphy, signing off. This recording contains general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax, and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. While we have no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Opinions of the host are not necessarily shared by other employees and partners of Torcana and its subsidiaries.